Hello and welcome back to Principles of Accounting 1. I am still your host, Dr. B. We made it to the end of the spring 2023 semester here at UDC. We have only a few days left of the term. It ends on Saturday, the 29th. Saturday, the 29th is the last day of the semester. I know, it's not Sunday, it's Saturday. So that's kind of a change for us. So the last day is Saturday, April 29th. What that means is I need you to complete all of your remaining coursework, including the homework assignments for chapters 15 and 16 by April 29th. The final exam will be next week. You have until next week to complete it. It's open and available now if you want to do it early. More than welcome to. Let's go ahead and jump into our conversation on investments, and then we will pause and start a new video for statement of cash flows, and then we'll have time for any type of wrap up. So let's talk about this concept called investments. Investing, when we talk about investing from a business perspective, usually we're talking about the purchase of property, plant, and equipment for the business to expand. We talk about those kind of investments. We also talk about the purchase of things like property, plant, and equipment for holding on to, then selling at a later date as a type of investment. We also talk about the purchase and sale of stocks, equities, bonds, etc. All those are forms of investments. The primary difference between an investment that's short-term and long-term is how long the business holds it. If we hold on to an investment for longer than a year, it's a long-term investment. Shorter than a year, it's a short-term investment. We're going to talk about all the different kinds of investments that businesses typically hold on to. So first, the difference between short-term and long-term investing. Companies will oftentimes invest some extra cash that they have available and invest that back into the company to produce a higher income in the future. The typical type of investments that businesses would make are the purchase of property, plant, and equipment to expand the business. The idea behind that is to generate higher income in the future. In most cases, businesses try to generate income from their investments into property, plant, and equipment. Sometimes a business might hold on to an investment to later sell and not use it to generate income, but to just sell it to generate additional profit later on. So there's really a few different kinds of investing that we're talking about. Almost every investment is strategic. There's a reason why we do things in business, and most of the time it's to strategic for future growth. We have short-term investing and long-term investing. Short-term investing are investments that the company holds on to for a year or less. Remember, short-term, 12 months or less. Long-term, greater than 12 months. So if it's greater than a year, it's long-term. Short-term, less than a year. The kind of short-term investments that companies typically make are the purchase of stock in other companies. Purchases stock in other companies. Those are typically short-term investments that a company would make. The reason why a company would purchase stock in another company is to have what we call leverage. That leverage gives the company that purchased the stock in the other company power with or influence the other company. You see, an example of this would be Microsoft purchased 30% stock in Activision Blizzard, which is a game manufacturer, a video game company. So Microsoft buys 30% stock in Activision Blizzard. The reason for this strategic move is to influence Activision Blizzard to create video games specifically for the Microsoft Xbox platform. Okay, that's one example of a short-term investment that Microsoft would make. Why is it short-term and not long-term? Because Microsoft would probably plan to sell that stock within 12 months or less. Or the opposite could also be true. Microsoft might decide to purchase more of that stock and ultimately possibly do a hostile takeover or put in a bid to purchase the entire company. Yeah. So these are just strategic reasons why companies might make these types of decisions. Short-term investing, less than a year. We quickly convert it into cash. Again, examples of this would be purchasing stocks or other securities within other companies. Long-term investing is typically longer than a year. Examples of long-term investing would be the purchase of property, plant, and equipment. The reason why property, plant, and equipment is long-term is because in most cases, the business invests in property, plant, and equipment, and they use it to help to generate cash in the long term. The company plans to use the property, plant, and equipment and keep it around for longer than a year. It's very difficult to sell property, plant, and equipment and quickly convert it into cash. Very challenging. Usually takes months, sometimes years. Okay. These investments are on the non-current asset portion of the balance sheet. So, in other words, the long-term assets, property, and equipment. Companies might make what we call debt investments and equity investments, also known as securities. A debt investment or a debt security is where a company invests in loans, bonds, and certificates of deposit. Example of this. A company might issue a loan to an individual or to another company. It's like a line of credit or some type of offering to a company in order to generate cash in terms of interest coming into the company. That's what we mean by debt investing. A company might issue loans or bonds or CDs to other companies, or a government might do that, or an individual might do that. When you hear debt securities, think offering loans, bonds, certificates of deposit. These are what we call debt securities. Equity securities is when the company might decide to sell shares of stock. The company issues shares of stock. That is a form of an equity security. Remember, debt, those are liabilities. Equity, that's what the owners own, right? The owners own, that would be things like shares of stock. Okay. When we account for debt investments or equity investments, go through a process. First, we identify what kind of security is it. Is it debt or is it equity? Then we decide whether the company is going to hold on to it for short term or long term. Remember, short term is 12 months or less, long term is greater than 12 months. And the third thing we do is we identify the percentage of ownership that the company has in other equities. These are the three things we do before we record the transaction. It's important to understand the difference between debt investing and equity investing. Debt investing is when we, company, are issuing loans, bonds, or certificates of deposits to either other companies, the government, or to individuals. When it comes to equity investing, this is when the company is issuing shares of stock. Okay. So your equity, think stock. Your debt, think bonds. Okay. You'll notice there's a couple of small definitions I also need you to be aware of. For debt investments, we have what's called held to maturity, trading, and available for sale. Held to maturity is when we hold on to that bond until it matures. Remember, maturity means when it's due. We talked about that when we talked about stocks and bonds. I think that was last week. When it comes to trading, that's when we buy and sell bonds, CDs, certificate of deposit on the exchange. We talked very briefly last week about this concept called securities exchanges. This is when we buy and sell things like bonds. The last part for debt investment is called available for sale. That's when I hold on to a debt security and then sell it later on. Available for sale. The idea behind that is that the company is gaining interest by holding on to that bond. When it comes to equity investments, the three definitions to know are insignificant influence, significant influence, and controllership. Insignificant influence is when the company owns a very small percentage of shares of stock in another company. Example, Microsoft recently invested heavily into Activision Blizzard, a video game company. In this recent investment, Microsoft started by purchasing about 3% of the available shares of stock outstanding in Activision Blizzard. That is what we call insignificant influence. 3%, it's very small. Okay, that's not going to influence any kind of decisions that Activision Blizzard does because it's only 3%. So, Microsoft decided to buy some more shares. Now we're getting into the area called significant influence. This is where Microsoft can influence the board of directors at Activision Blizzard. Now Microsoft owns 30% of the outstanding stock in Activision Blizzard. It's what we call significant influence. Microsoft at that point was one of the larger shareholders in Activision Blizzard company. And now most recently, Microsoft decided to purchase more Activision Blizzard shares to the point where they become the majority owner of the company. In this purchase, Microsoft is now the controlling interest in Activision Blizzard. See, with controlling interest, Microsoft can dictate to what Activision Blizzard does from here on out. That's the concept behind those three definitions. So think insignificant influence, small amount of shares. Significant influence, majority shares. Controllership, influence the whole company. Yeah. Here's an example of a company that decided to issue a bond. He issued a bond July 1 for $30,000 to Dell. It's 7%. It's a 2-year bond, so it's long term. It's payable at 30% par value. Okay, so face value. There's an interest payment semi-annually, so twice a year. The company will receive because we lent money basically to Dell. It's a 2-year bond. We debit what we call a line item called debt investments for $30,000. This is a long-term asset account. Long-term asset account, debt investments, because it's greater than 1 year. And it's an asset because it's an investment. Okay, the company owns the right to that investment, therefore is an asset. So debt investments, $30,000. Credit cash, $30,000 to represent the cash that we are lending to Dell through the bond. And of course, Dell will pay interest twice per year. On that $30,000 at 7%. Remember the formula. It's the face value times interest rate times time. Face value $30,000, interest rate 7%. Time is every 6 months. So 6 over 12. This means that we'll receive $1,050 every 6 months for a period of 2 years until the bond reaches maturity. So we debit cash and credit interest revenue. At the end of the bond, the company that we issued the bond to, they need to repay that bond. They have to repay the face value of the bond at the maturity date. Remember, the maturity date simply means the date that it's due. So we debit cash $30,000, credit investments $30,000. They're both asset accounts, right? So all we're doing here is we're increasing cash and decreasing the debt investments. They're both asset accounts. So don't worry, the accounting equation is still in balance. It always is. Let's talk about when we trade the debts. Trading debts is when we are purchasing or selling bonds, certificates of deposit on the market, okay, at market value. So a couple things happen here. These are debt investments that we're talking about. They're actively managed for a profit. When you see actively managed for a profit, that means that I'm holding on to that debt security so I can earn interest on it. I get paid interest when I issue that bond. Okay, I did that for a profit. Then eventually I'm going to sell that bond and hopefully make an even higher profit. These are current assets. The reason why. When I am trading debt securities, it's called a current asset because the plan is I'm going to sell this debt security within 12 months or less. You plan to sell something in 12 months or less, it's current. It's current. You might know someone who's in the real estate business, and what they do is they buy and sell houses. They're called flippers, right? They'll buy a house, fix it up, and then sell it. They do that in a very short amount of time, usually a few months, maybe a year. When they purchase that house, they don't put it in long-term assets. They put it in short-term. The reason for that is because there's an intent to sell it in less than 12 months. When that intent exists, it's short-term. Portfolios are reported at the fair market value. Any unrealized gain or loss from the sale of that debt security is reported on the income statement. The rules when it comes to debt investments for trading them. Here's an example of this. Here we have a debt investment that the company sold for $1,500 as above its fair value. And so we record that $1,500 by debiting fair value adjustment for trading and crediting the unrealized gain, which is an income account. And of course, if there's any cash involved after the cost is recorded, record that cash gain by debiting cash and crediting the debt investment. When I hold a bond or a CD to security, when I hold a certificate of deposit or a bond to maturity, it has these reporting requirements. It's a debt security. We intend to hold it until it matures. In other words, when the face value is due. And we report it as a current asset if it's due within a year or less. Or to be non-current if it's greater than a year. And this is called a portfolio of held to maturity securities. And it is considered to be an amortized asset. Don't worry too much about I'm not going to have you worry too much about something like that. When we hold a security available for sale, this means we intend to sell it within 12 months or less. I purchased a bond on the bond market at face value, and I intend to resell that bond on the bond market in the next few months when I expect the interest rates to rise. Therefore, I'll make a gain on my sale. I'm holding the security available for sale. That's what that means. These are the rules for available for sale debt investing. They're not held to maturity because I'm going to sell it quickly. It's short term because I expect it to sell within a year or less. I record it at its fair value. And if there's an unrealized gain or loss, I record that when I sell it. The word fair value simply means what it's worth at the time. What it's worth at the time. That's the fair value. How do we know what it's worth? Look at the open market to determine its value. Therefore, it's the fair value. Oftentimes, companies use the market price to determine fair value. We, as individuals, do the same things with our personal assets, like your car or your house. What's the value of your car? It's the fair value, whatever the market says it's worth. Okay. What's the value of your house? It's the fair value. It depends on how much the market says it's worth. So that's how we find fair value, typically. There might be some nuances there, but that's how it normally works. So this just kind of shows you an example of this. I'm not going to dive too deep into this concept. In some cases, the available for sale security will extend from one accounting period to another. For example, if I purchase a security, a debt security, and I don't plan to sell that right away, and I go into the next year and then sell it, but still within 12 months or less, we have to report that market gain or loss at the end of the respective year. What I mean by that is we have to make an adjusting entry at the end of the year to adjust the value from one accounting period to another. And that's what this example shows us. When you get further into that, that'll be in like an advanced accounting course. If you're an accounting major, you'll get real far deep into this in your advanced accounting courses. If you're a finance major, you'll definitely see this again, I promise. But for today, don't worry about it. Now let's talk about equities. We talked about the debt investments. Let's talk about equity investments. Remember, equity investments, we're talking about stock. Okay. Using my example of Microsoft investing in Activision Blizzard, the video game company. This is what I'm talking about. The influence. 3% was the original purchase of the stock. That's insignificant. It's below 20%. There's no influence there. Microsoft can't go to the board of directors at Activision Blizzard and say, hey, I want you to do this, this, and this. They only own 3%. I mean, that's like nothing, right? A whole 3%. Oh, wow. Then they purchased more, right? Now they purchased 30%. 30%, that is significant. Okay? 20 to 50% is considered significant. They can go to the board of directors at that point and say, hey, I'd like to vote for you to do X, Y, and Z. That's significant influence. When Microsoft decided, you know what, I think we should just buy this company, The way to do that is to purchase 50% or more of the company's outstanding stock. At that point, it put them into a controlling interest situation. At that point, Microsoft basically owns Activision Blizzard, and they can dictate whatever they want to the board of directors. They could even vote to remove the board of directors and replace all of them. Right? That's the idea behind controllership, is you control the company operation. A couple of transaction examples of this. When a company purchases stock, we debit stock investments. The stock investments are recorded on the balance sheet, and we credit cash. When we sell those stock investments, or when we receive a dividend, we debit cash and credit dividend revenue. A dividend, just in case you forgot about what a dividend is, I think we talked about it last week or the week before. A dividend is kind of similar to interest. They give me a dividend because I own that share of stock. It's when the company distributes their excess profits to the shareholders. Board of directors votes to say, hey, we're going to give X amount of money to the shareholders as a thank you for owning this share of stock. That's basically what a dividend is. So debit cash, credit dividend revenue when we receive a dividend. Yeah, that's the concept of it. The value of stock, as you probably are aware, goes up and it goes down. Depends on the market, right? Value of stock goes up, it goes down. Depends on the market. When it goes up, we have to adjust. So at the end of that accounting period, the end of the year, we make an adjusting entry to realize the increase or decrease, depending on what happened, of the value of the stock. And we do that through either unrealized gain or loss. Of course, if it's a loss, it's the opposite, right? That's the basic concept behind it. When I sell a share of stock, I debit cash, credit my stock investment, and then I credit the gain on the sale of the investment. If it's a loss, it's on the other side. It's a debit. When a company has significant influence, it's that middle part, the 30% in my earlier example. There's a couple of other entries that we make. An example of that is the purchase price you'll see is higher, 30%. Means I'm purchasing 3,000 shares instead of 30 shares or 300 shares. 30% ownership, you'll notice that when I make my adjusting entries, those adjusting entries are made based off of the number of shares that I own. Okay. You'll also notice that when you own a significant influence or greater, that significant influence most commonly means that you're sharing in the profits because you have significant influence. You have a larger amount of shares that you own. That's the concept behind it. It also means that we record the book value when we have significant influence. That book value means that I take the value of the number of shares that I have in comparison to the company I invested in, outstanding stock balances, and I apply that to my company's balance. Because I technically own 30% of that company. That's what this tells us. Of course, when I make a sale of stock, I go through the same process of recording, debit the cash, credit the investment, and credit the gain on the sale of the stock. This is where it gets a little bit more interesting. Controlling influence is where we own more than 50% of that company. Okay. Example, Microsoft first started with 3% of Activision Blizzard stock. Then they purchased more. They went up to 30% of the stock. Now we're at 60% of the stock. That's greater than 50. So that means Microsoft technically owns Activision Blizzard at this point. Because Microsoft owns more than 50% of Activision Blizzard, Activision Blizzard's financial statements now fall under Microsoft's. Microsoft is now considered to be the parent company for Activision Blizzard. Okay. That's the concept behind the reporting process when it owns more than 50%. If you own more than 50% of anything, you own it. You're the owner. Yeah. That's the idea. So that also means that you're ultimately responsible for their financial statements. This slide just kind of summarizes both the equity and debt investments that we just talked about and the influences, how we report them. Comprehensive income is a commonly used term that represents all the changes in equity that have happened during an accounting period when there is a controlling stake. An example of this is with Microsoft and Activision Blizzard. On Microsoft's financial statements, there's going to be line items for things like comprehensive income. The word comprehensive simply means that there's more than one element involved. When one element involved means it's comprehensive. That's the idea behind comprehensive income. There are, of course, ratios involved that we need to understand because we need to be able to determine whether an investment into debt or equity is worth it, right? And one of these ratios we would run is called return on total assets. The return on total assets tells us how well we're utilizing our assets. This would include things like debt and equity investments. To find return on total assets, we take net income divided by average total assets. Average total assets comes from the beginning balance and ending balance divided by 2 to get your average. Beginning balance plus ending balance divided by 2 to get your average. We can also break this equation out by saying it's profit margin times total asset turnover. It sounds a little bit more complex, right? But really it's just net income divided by average total assets. Remember, To find the average, it's the beginning balance plus the ending balance divided by 2. It's just a nice example of how to run this. We like high returns on our investment. The higher, the better. Right? Okay, that was our conversation on debt and equity investments. Any questions on debt and equity investments before we roll into our conversation on the statement of cash flows? Any questions at all so far? We doing okay?
Yeah.
Yes.
That's what I like to hear. Wonderful. Thank you so much. Let me go ahead and stop this part of the recording. I'm going to start a second video for our discussion on the statement of cash flows. Stand by.